welcome to Investor's Guide. You're watching ET Now. I'm glad you joined us on the show this week. We've put together a very helpful show. We'll first give you a checklist on how you can find those perfect investment products, and then we'll go on to look at your portfolios and figure out how you can adjust those products to suit your needs. You can write to us. There's an email ID at the bottom of your screen. You can also reach us on our Facebook page. Let's get straight to it. Over the next half hour, we'll first help you choose the best health cover for your parents who are senior citizens. We'll also help a 44-year-old plan for his son's education. In our product review, we look at the Kotak 50 fund this week, and we'll find out how aggressive can your expectations from your equity investments really be. So over the last several weeks, we've noticed that most of the emails we received from you ask us about senior citizens' health insurance plans. Now, with the rising cost of healthcare on one end, it's important to make sure that our parents who are likely to need that periodic healthcare most are insured. Thankfully, there are several products in the market for us to choose from, and most insurers are working on those products every day to innovate them and make them better. So how do you find a product that suits your family's needs best? We put together this helpful checklist. Take a look.
I'm not going to go down the emotional road and talk about all the love and support our parents have given us all our lives. It's our turn now, and doing the right homework for all their financial products is the least we can do in return. The Senior Citizens Health Plan is a non-negotiable component to our parents' portfolios, and it needs the most research. Now keep in mind that buying health insurance for a senior citizen comes with a lot of clauses and conditions. You might be tempted to include senior citizens in your family floater plan, but this will hike up the price of your entire product and will leave your family underinsured.
When you try to combine your parents into your own standalone policy, what happens, insurance companies start calculating the overall family size starting at the senior age, and the overall ticket size shoots up, where a standalone policy for senior citizen is usually cheaper.
So you need to pick a separate policy for your parents. But how do you choose a health plan that suits their needs? Here is a useful guidebook. For starters, you need to buy the policy as early as possible. Even though some health policies will let you enter even at the age of 80, the premium gets significantly higher as the age advances.
Typically what happens is that you will have a slightly higher premium per lakh or sum assured because these plans have been designed in such a way where the waiting period for pre-existing illnesses may be lower. As a result, there's a slightly higher risk to the insurance company, and that gets loaded into the premiums.
Next, ensure the policy covers your parents for as long as possible. Some covers are valid lifelong, while most others will cover senior citizens only till a specified age, usually between 80 to 90 years. Third, make sure your parents' pre-existing illnesses will be covered by a new policy. There is usually a waiting period of a year before the insurer will take on the responsibility of covering a pre-existing illness.
Pre-existing illnesses will be covered after the waiting period is over in senior citizen plans, subject of course to any particular exclusions which might have been made for a particular policy. In some cases, the pre-existing illnesses will be covered even during the first year, subject to, say, a maximum 50% cover.
The biggest medical expenses come from treating critical illnesses. Most senior citizen health plans cover a few select critical illnesses. So make sure you pick a policy that covers as many illnesses as possible and be aware of what is excluded from the plan. Finally, you need to understand the co-payment ratio on the policy. No policy will pay your entire hospital bill. You will have to pay a percentage of the bill, while the insurer will pay for the rest. You need to make sure that your share of the bill will be as low as possible, and that the insurance company will pay the lion's share of the bill.
Today, some of the products available for senior citizens have very high co-payment. They have co-payment ranging between 40 to almost 50%. So even if you take claim against hospitalization, you will have to pay a large amount from your wallet.
So here's a recap of what you should be looking out for. Buy the policy as early as possible. Choose a policy which offers lifelong coverage. Check for the waiting period of pre-existing illnesses. Check what critical illnesses it covers. And finally, find out what your co-payment ratio will be.
So remember, make sure that your parents and your senior citizens at home are all insured. It's very important to the security of your family and the security of your savings. Let me bring in Virendra Kumar now, the CEO of Value Research and our in-house mutual fund expert who answers our questions every week. Virendra, it's always a pleasure to have you on this show.
Thank you.
Let's get straight to our portfolio versus portfolio question. Dinesh has written in, he's 44 years old and he's created a portfolio to plan for his 8-year-old son's education. Now he tells us he has a 10-year horizon. I'm looking at his list of funds, Virendra. He has about 4 very good diversified equity funds. He has one offshore fund, one investment opportunities fund from DWS.
These 4 funds can potentially give him a good combination.
Alright, if he pulls his money out of the other 3 funds that he's invested in, should he just divide it equally among the 4 funds you've recommended for him?
Yes, I would think so, except for IDFC Premier Equity, which should be a, relatively lower allocation. But other 3 are, mainstream diverse fund with different style. These 3 funds combined together should be the core, his 80-90%. And IDFC Premier Equity should be relatively less.
Alright, so that's the advice you're getting. HDFC Equity, Goldman Sachs CNX 500, IDFC Premier Equity with a slightly lower allocation, and Tata Dividend Yield. These 4 funds should get you through the next 10 years and you should be able to meet your target. Let's move on now to our hold or sell segment. Bharat has written in, he's 60 years old, Virendra, and he's invested in mutual funds, which he tells us contribute to 50% of his annual income. Now, he wants to streamline his portfolio and consolidate his funds. We have to remember that he's retired and he's deriving an income from these funds now. And he has a very large list of funds, and I'm going to take them in groups of fund houses. So his first list is HDFC Equity, HDFC Mid-Cap Opportunities, HDFC Growth, HDFC Balance, and HDFC Multi-Cap. Now, he doesn't need to have all of these in his portfolio. Obviously, if you could just pick one that he can invest his money in, what would that be?
I would say, given his expectation and 50% of his income being derived from these funds, I think he needs to get really stable, into the most stable fund from this selection. I would say he should focus on HDFC. He should move all his money to HDFC Balanced, and it will be a compromise on return in good times in a rising market, but it will save him a lot of anxiety. At the same time, he will be able to beat inflation, which should be his goal in retirement.
The next on his list are funds from the Reliance Fund House. He has Reliance Vision, Reliance Growth, and Reliance Equity Opportunities. I'm not really sure how this will be someone who is in his age group, but is there any among these that you'd like him to hold on to?
Yes, I think, Reliance Equity Opportunity is an impressive fund of the 3 that he holds. But given, his expectation from his investment and, depending for 50% of his annual income from these investments, I think he should avoid equity altogether. The ideal thing should be, either getting into a MIP or at most, 30 to 40% into balanced fund, remaining into MIP. I think our income-oriented portfolio, which is designed with this objective in mind, that you invest your money, it should be able to beat inflation. I think those goals will be met with that portfolio.
Alright, our income-based portfolio is flashing on your screen right now. Remember, Virendra said in your age group, this would ideally be the funds you should be investing in. But let's go back to the portfolio, Virendra. The rest set of funds also look very similar. Franklin India Blue Chip, Franklin India Prima Plus, Templeton India Equity Income, and Templeton India Growth Fund. Now, among these, would you recommend he hang on to at least one of them, or should he be pulling his money out of all of them at this point?
In fact, all the 4 funds are good, but they don't match with his goals. He should, seriously consider moving all his money into these funds. He will be exposed to the Templeton Equity Fund, Equity Universe. If he has to simplify based on his existing portfolio, I think he should move all his money to Templeton India Balanced Fund.
Alright, Bharat, that's the advice you're getting right now. This portfolio might have been great to accumulate your money up till now, but now that you are in retirement, you need to change your investment strategy. Now, one of the things that you can do, like Virendra said, is consolidate your portfolio into HDFC Balanced, Reliance Equity Opportunities, and Templeton Balanced Fund. Now, alternatively, we have a portfolio that's designed from someone exactly like you. That's our income-based scheme. That's flashing on your screen right now. You can use that one as well to substitute the investments that you have at this point. Good luck, and write back to us if you need anything else. We have a quick question from Kanika, Virendra. She tells us she makes 9 lakh rupees a year. She wants to build a corpus of 25 lakh rupees in 2 years. Now, the good thing is she can invest her entire income and she can put all of that money away. The bad thing is she wants a return of about 40% in 2 years from that money. Do you think that's possible at all?
It can't be ruled out. There has been occasion, when the market has gone up by 100%, but it is not a bankable thing. In fact, those kind of returns are generated when you least expect it. And trying to get a predictable 40% in next 2 years, given that you only have those 2 years, there is a great possibility that you might earn 20-25% annual return on your investment year on year. Next 2 years, this time frame, serious goal, it is a very unreasonable expectation. And for this kind of time frame, one should not be taking any chances. If somebody comes to me with a 2-year time frame in mind, I normally suggest keep your money in the bank or put your money in a short-term fund, which is unlikely to deliver anything more than 8-9%.
All right, Kanika, unfortunately, you can't expect more than 8-9% if you're looking for an assured return. If you're willing to take a chance on the market, then like Dhirendra said, it could be anywhere between 20% to 100%. That's not a bankable return. After the break, Dhirendra is going to stay with us and we'll talk about our big fund of the week. It's Kotak 50. We'll find out if it can come up to the kind of returns that we saw it give us maybe about 3 or 4 years ago. That's after the break. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. It's time for our product review this week. We're looking at the Kotak 50 fund. Avan is here to give us an introduction into that fund. Avan.
The Kotak 50 fund was launched as Kotak 30 in 1998. It was initially meant to invest in only 30 large cap stocks, but in January last year, its investment objective was modified to hold up to 59 stocks to reduce volatility. The fund has underperformed some of its peers over different time periods, but it has managed to keep pace with its benchmark. We've also noticed a slight improvement in its performance post the change in the investment objective. While Kotak 50's large cap bias has helped it contain declines and tide through the market volatility, its performance during market rallies has been patchy. In 2009, the fund delivered 91.2% on the market recovery, while the CNX Nifty managed 102%. The fund, however, made a notable comeback in the volatile market of 2011 and limited its losses to 18% when the Nifty lost 24.6%. Let's take a look at some numbers. If you invested 1,000 rupees in this fund when it launched, you would have 9,590 rupees today.
This fund was at the number 5 spot in its category chart about 3 years ago, but then since then it's dropped. It's come down to about number 22. Can you tell us what went wrong, and if this change in investment objective that it's done last year, will that show an improvement in its performance?
This has been a very well-defined fund. It has stuck to its mandate. It started as Kotak 30. In the interim, it was decided that, 30 is too narrow a mandate. 30 meant that, the portfolio will never go beyond 30 stocks. And when it faced a problem in terms of not enough diversification or missing out an opportunity or a constrained mandate, then it expanded it to 39. Now it's called Kotak 50. And that has come in very handy. Because the fund portfolio was always focused, it never had a long tail. It was not taking small positions or low conviction positions. And that proved to be extremely useful strategy in the first 10 years. But what has happened since 2007 is that, on a relative basis, many of its calls didn't work the way it used to. And it has gone down on relative performance. But I would say that, given the mandate, given the stated objective, it is so tightly defined that this fund can't really commit blunders. And that is a good thing. So I'm hopeful that, if some calls go right, it can be among the best performing fund. Worst case scenario is that it has always been an above average fund even in the bad times.
But Dhirendra, in comparison to other large cap funds that we normally talk about, like the Franklin India Blue Chip or the ICICI Prudential Focus Blue Chip Fund, does this fund compare? So for investors who are in Kotak 50 right now, should they stay hoping for that turnaround that you were talking about?
It's very difficult, to be always in the best performing fund all the time. I would not write off this fund. I would say that, of course,
Franklin Blue Chip and ICICI Prudential Focus Blue Chip are excellent fund today. But they can also face a similar thing. Yeah, I remember very clearly that till 2006, Franklin Blue Chip had a similar state, and then it made a remarkable comeback. So I would not write off this fund. It's very difficult to be in the best fund beforehand, and and hindsight is perfect. This fund may not. It's very it's more important that which is going to be the best performing funds after your investment than investing in a fund which has been the best performing fund, banking on continuity of the same performance. So I would say this fund is worth taking chances given its tight mandate.
All right, Dhirendra, finally your rating of the Kotak 50 fund, where would you place it?
I would place it as an above average fund and will assign it a 4-star rating.
4 stars for the Kotak 50 fund on Investors Guide. We have one more quick question. Rakesh has written in from Indore. He invested in the Reliance Natural Resources NFO. He also invested in Reliance Infrastructure and the Diversified Power Sector Fund in 2008 and 2009. He tells us, not surprisingly, that his investments have given him negative returns at this point. He wants to know what he should do. Is it time to cut his losses on those funds, Dhirendra?
Just because he invested in the IPO and at the wrong time, that may not be the real rationale. The real rationale why he should get rid of these funds and move into more diverse fund is that they are not desirable funds for investors if these are the only funds he has. Say for example, the infrastructure fund or the natural resources fund or the diversified power sector fund. They were best performing fund, or they were very popular fund, or there was great hype around their launch, and a lot of investors invested in their launch. So that may not be a good idea. I think if he has to invest in a Reliance fund, maybe he should consider a Reliance Equity Opportunity or a Reliance Regular Savings Equity Fund, and diversify his and move his money elsewhere into similar funds, more diverse funds.
All right, Dhirendra, thank you so much for answering our questions on Investors Guide. If you have a question for Dhirendra, feel free to write to us on the email ID at the bottom of your screen. You can also reach us on our Facebook page. Coming up after the break, Gaurav Mashruwala joins us to answer your questions on your other investments. That's after the break. Welcome back. You're watching Investors Guide on ET Now. Gaurav Mashruwala joins us on this leg of the show to answer all of your investment-related questions. Gaurav, thank you so much for joining us. Our first question comes in from Nishan. He wants to know where he can invest 50,000 rupees a year for the next 30 years to get a monthly retirement income of 35,000 rupees.
So first phase is talking about accumulation, and second phase is talking about after regular income. Investment strategy for both will be different. When you are accumulating money from long-term perspective, you look at asset classes which are growth-oriented, like real estate, like gold and equity. Now, amount he is talking about, real estate is ruled out because you can't keep buying and you can't pay for real estate in bits and pieces over the next 30 years. So he's left with two choices, equity and gold. Now, if he's conversant with equity market, he can dabble into it directly. Alternatively, pick up an equity mutual fund, so that on every month you're doing a systematic investment plan into an equity mutual fund as well as a gold fund. After retirement, you should take out this money, because after retirement you have three distinct requirements. One is liquidity, for which you put money, contingency money, you put in savings bank account linked to fixed deposit. For your growth, you put money into an equity fund or a gold fund, or a combination of two. And for regular income, at that point of time, whatever annuity options are available, like post office monthly income schemes, resident savings scheme, that should be considered.
Right, and our last question for the week comes in from Saurabh, who writes in saying he's an engineering student. He can save about 15,000 rupees a month right now. He wants to know where he can invest this money to create a corpus to buy a house for his parents. Now, that's a noble intention. He also plans to pursue his MBA in a couple of years, and he wants to plan his finances accordingly. Gaurav, what can he do?
Now, if 2 years is his goal, then debt-based instrument is his obvious choice, because equity in 2 years could be highly volatile. If he is not in a higher tax bracket, because he is able to save 15,000, but he has not said where is that money going to come in. Is it the parents are going to give it to him? Is he earning from somewhere? So ideally I would encourage, if he's in lower tax bracket, recurring deposit is a better option, because recurring deposit currently are offering higher rate, almost like a fixed deposit. Debt funds could be a good option, but debt funds returns are not certain. They are tax efficient, but since in a lower tax bracket, that doesn't make sense. So he can lock into a recurring deposit offering 9 to 10% interest, and after 2 years take out that money for his education.
Right, so that's a wrap on Investor's Guide this week. Thank you for joining us. Gaurav, always a pleasure to have you on the show. Remember, if it has anything to do with your money, feel free to write to us with the email ID that's at the bottom of your screen. Tune in next week to catch the show. Thanks for watching.